clearly, I mean, all the forecasts are for so far relatively mild recession next year. Our economists also presented their outlook for the winter, so we're expecting a recession in this winter. What we do in the financial stability report is to say, well, how resilient is the financial system in case the situation gets worse than it's currently expected? So what if the energy crisis worsens, and how much resilience do we need in the system? And the message is very clear, is namely, we need a resilient financial system. We need to keep building up resilience over the next period of time.
So let's talk about the knock-on effects the challenging macro environment is actually having on the real economy. In this report, you talk about increased collateral requirements on the back of increased energy volatility. How is that translating, and what forms of credit stress are you witnessing right now?
Yeah, I think you're referring to what happened on energy markets. So as you know, since the global financial crisis, there's a system of central counterparties. And for energy derivatives, these trades are organized by the Leipzig stock exchange. And what we've seen there is that we had a very abrupt increase in energy prices, very high volatility on markets. So the CCPs asked for higher margin calls from their clients. Now, the clients are banks, and the clients would go to their customers, namely the energy companies, to actually meet these margin requirements. And there was some risk of liquidity stress because the companies couldn't deal with this increased margin calls at very short notice. So there, the German government came in. So there were credit guarantee programs organized by the Kreditanstalt für Wiederaufbau, and that stabilized that market segment. So that was a very specific situation in the German market. And we've seen that these fiscal measures helped to stabilize the market. Now, we should also say that the financial sector certainly can't rely on fiscal support coming in directly or indirectly in the future. So we also need the financial system to be sufficiently resilient against a general increase in credit risk, which is clearly in the pipeline because of the recessionary tendencies that you mentioned, because of the stress that the current risks are imposing on the German economy. So yeah, we need more resilience in the system also to deal with heightened credit risk.
Fascinating what you have to say about fiscal support. To what extent do you think the government support so far has cushioned the blow on households and businesses?
Oh, I don't have a number for that. And what I spoke about was actually the support giving to the energy companies, so related to this margin calls in the CCPs. So the current fiscal package is still under discussion, and I wouldn't want to comment on it. And we also don't have an assessment of what exactly it means for the financial system. But I think the clear message that we have is that the financial sector can't count on fiscal support coming in, which directly or indirectly supports the financial sector. So we need sufficient buffers in the financial system to also deal with losses and to be able to absorb those losses.
So far, you've talked a lot about making the system more resilient. What are some of the recommendations that are being put forward to help make the system more robust?
Yeah, it's not only recommendations, but it's actually actions that have been taken already. So the German supervisor BaFin actually increased the counter-cyclical capital buffer for banks earlier this year to 75 basis points, and the banks have 1 year to comply, so until early next year. And this is exactly to provide the resilience against adverse macroeconomic developments. So this is already taken into account analysis that we've done over the years, which clearly showed that the system has become more vulnerable to macroeconomic risks. And we think that this buffer, the counter-cyclical capital buffer, there's also an add-on for real estate risk. This is still very well justified. So the banks do have sufficient excess capital. We do not see that credit supply would be constrained because of these buffers. So I think we still need the resilience in the system going forward.
I want to turn the focus to real estate and house prices. In this report, you say you do not expect to see a significant correction in house prices, though for years we talk about an overvalued house market in Germany. Why are higher interest rates not impacting the real estate market more?
Yeah, so let me first of all give you some recent evidence on the real estate market. So the pricing and the potential overvaluation has been a discussion for many years. So we do see a slowdown in the price growth for residential real estate, but it's not that the overall dynamic has reversed. So we still have overvaluations in the market. What we are concerned about is also to what extent this is driven by a loosening of credit standards, by a very fast growth in credit, residential mortgages. And there we also see a slowdown. So we don't currently think that additional measures are taken to slow down the buildup of vulnerabilities in this market segment, but we do think that we need to keep monitoring the market because we know that, of course, private households are very much exposed to mortgage loans. So that's the biggest component in private household debt. As to the impact of changes in interest rates, you have to be aware that the German mortgage market is a bit different than the market in many other countries. We have a very high share of mortgages with fixed interest rates. So that mitigates the impact of rising rates for households. Of course, the risk doesn't disappear. It's still in the system, but this exposure to changes in interest rate risk is largely with the financial sector, the banks who've done that borrowing, that lending, with regard to mortgages.
The report also talks about very low real interest rates. So nominal rates, as we know, have been moving higher, but so has inflation, which means the level of real interest rates is still quite negative. And the report says that this will create some further vulnerabilities in the system. What remedies that? Is the expectation that inflation will come down, which will help these real interest rates normalize, or is it a matter of nominal interest rates having to rise further?
Mm-hmm. Yeah, so you're absolutely right. So real rates are still negative, but we don't usually read real rates being quoted in the newspapers or when we talk about interest rates. So we thought it's important to actually point that out. And what we're saying in the report is that negative real interest rates, and it depends, of course, much on what's the relevant price level for you as an individual borrower, that negative real interest rates still provide incentives to borrow. So we shouldn't just look at the nominal rates. And we don't really discuss what are exact remedies, but of course, growth in the real economy. So how fast the restructuring in the real economy takes place, how fast we succeed with monetary policy also to bring down inflation and inflationary expectations. All that has an impact on real rates.
Can I ask you, looking ahead, what you think the biggest challenge is? Is it that the German financial system will not be able to withstand increasingly high levels of inflation in the future? Is that what you're most worried about at the end of the day?
I wouldn't say it's the inflation. I mean, we're all worried about inflation, and it's also the we know there's many reasons why inflation is high. This has a lot to do with the energy prices. It has a lot to do with the changes in the real economy, the demand and supply conditions in the real economy after the pandemic. But of course, monetary policy has an extremely important role to play also to contain inflationary expectations. For the financial sector, rising interest rates are actually that come with higher inflation are actually also to some extent a stabilizing element. So it's on balance how higher interest rates affect the financial sector depends on many conditions. So I think for me, the most important issue for the future is how the German economy in general deals with the structural change that is coming, and that we want to make sure that the financial sector is sufficiently resilient so that it can support structural change. And some of the measures we just discussed are just in that spirit, increasing resilience and making sure that the financial sector is really supportive to real economic growth.